Covering all these aspects of the fixed income market, that is the bond market, money market, and small saving instrument, in one video will be very long. So what I will do is I will divide this entire subject into three videos. In the first videos, we will start with analysis and need of the debt market till pricing, yield, and yield curve analysis. So we will do everything about the bond market in video number part 1. In part 2 of this video, I will do the entire analysis of the money market and corporate and debt market. In the final video, that is part 3 of this fixed income, I will give a glimpse of the various small saving instruments available to investors. So this fixed income market basically will have 3 videos. Part 1 will give everything about the bond market. Part 2 will give everything about money market, and part 3 will give you various small saving instruments available to retail investors. Let us understand what is money market. See, these concepts are all forms part of the your bond market. So let us understand what is money market. One, see, money market provides a short term and ultra short term lending and borrowing of funds. So money market is basically meant to provide short term and ultra short term lending and borrowing of funds. It may range from overnight to 1 year. Okay. Now coming to participation in money market. See, participation in money market has two different types. Okay. One, fundraising, and two, asset acquisition. See, participation can happen in two different ways. Okay. It can happen for fundraising also, and it can happen for the asset acquisition also. Now, see, money market is basically used for funding short-term liquidity mismatches. Especially, money market is used by primary markets, PDs. Then it is used by the banks, RBI, and corporates. And we should understand that the entire liquidity condition in the banks for short term and long term is dependent on the money market. So hence money market is very important for a country's financial infrastructure. Now let us understand who are the key players in the money market. See, retailers will not be a key player. Now first one is the government, as I have told you, corporates, banks and NBFCs, insurance companies, pension funds and provident funds, and payment and small finance banks. So these are the major contributors in the money market. So there are various components of the money market. We will understand one by one, each one of them. Okay. See, first of all, call money. Call money means any bank can ask money from the money market infrastructure that they want money for the overnight. Okay, the RBI can say, okay, I will give 100 crores to one bank for overnight. That is overnight means for 12 hours lending. So that is called as call money. Call money is usually overnight lending, but it is an unsecured lending. So no collateral will be taken while giving the money. It is an overnight borrowing and lending instrument. See, it is basically restricted to scheduled commercial banks and primary dealers. I will explain who are primary dealers at a later stage. Okay, because it's a little bit, slightly complex this thing. I will explain it after, at the end of this presentation. See, Call money is usually operated. See, most of the concept I'm going to explain, money market instruments which I'm going to explain, is operated on the RBI NDS call platform. That is Reserve Bank of India call platform. And this is managed by the Clearing Corporation of India Limited, CCIL. Here, for call money, the minimum market order is 1 lakh rupees. Next comes something called as notice money. Again, it is an unsecured lending. It is not overnight, it is beyond overnight for up to about 14 days. See, we must understand for 14 days there is going to be an unsecured lending without any collateral. Again, it is restricted only to commercial banks and primary dealers. It is operated on the NDS call platform and this is managed by CCIL. Here also the minimum market order is 1 lakh. Next is term money. Again, it is an unsecured lending. It is for 15 days to 1 year. It is restricted to commercial banks and it is operated on the call platform, and here also the minimum market order is 1 lakh. This is a very important concept, this market repo. Market repo is also referred as forward contracts. It is the sale of security to lenders and agreeing to borrow them at a later rate along with interest. Simple repo rate. What you say, lenders will give you 100 rupees. You will say after 1 month, I will give you 102 rupees. That is called as, in a simple layman term, this is called as market repo. Okay. So then the interest will be included in the repurchase price. That's what I'm saying. If I give you 100 rupees and if you say I will give you 102 rupees afterwards, this is market repo. Simple concept. It is again a non-collateralized lending, but it is also an unsecured lending. However, Reserve Bank of India regulate the repo market very strictly. Here the market participants include commercial banks, NBFCs, financial institutions, pension funds, insurance companies, corporates, etc. Here there is a different platform. Here repo transactions are reported on Clearing Corporation Repo Order Matching System, that is CROMS they call it. Here the minimum market order is 1 crore. Now something called as a tri-party repo. See, it is the same as the repo rate contract, except that there is an intermediary called as tri-party agent, TPA. The job of the tri-party agent is he will select the collateral. See, the concept remains the same. You give 100 rupees to somebody and somebody will give you 102 rupees. But there will be a agent in between. He say to the person who is taking money by you, I want selection of collateral. That is, you will give me, government's bonds if you are holding, you give it to us as security. That is called as selection of collateral. So the tri-party agent will select the collateral and he will settle the payment and he will keep the custody and manage the collateral given by the borrower during the repo period. Clearing Corporation is presently acting as the tri-party agent for any of the transaction of tri-party repo happening. CCAL created Collateral Borrowing and Lending Obligation CBLO on January 2003. So this was converted to TREP on 5th November 2018. The tri-party repo dealing system, TREPS, is an anonymous trading platform and is provided by CCAL. Even our national stock exchange where we do trading is also an anonymous trading platform. We don't know from whom we are buying the stocks and the person who is selling don't know whom he is selling. That is known as anonymous platform. There is nothing technical about it. It's very simple. The wording is a little bit, complex. That's all. All market repo participants, whoever the market repo participants are there, they can trade on this TREP platform. Just the way retail traders can trade on Zerodha, they have another platform specially for this repo market participant. Zerodha, I'm just taking the name. Zerodha, it can be any other brokerages. TREPs are exempted from RBI's cash reserve ratio, and statutory liquidity ratio computation. See, whatever money which is being circulated in this TREP system will not form part of the cash reserve ratio and SLR. It means it can lend over and above CRR/SLR limits when lending. I will explain what is cash reserve ratio and what is statutory liquidity ratio in the next future slides. Okay. All these TREPs which is being traded on this platform, that is CVLO platform, has a face value of 5 lakh and multiples thereof. I hope you understood what is tri-party repo. I am giving 100 rupees. Somebody is taking 100 rupees. In between there is one person. I give 100 rupees to that person, and that person speak to the borrower and tell, see, I am giving 100 rupees to you. Please give me collateral. You give me your bike or you give me your bonds which you are holding to me. So he will hold it and give 100 rupees. And he says, you will give me 102 rupees afterwards. So he will give everything to the borrower. Borrower will take it, and at the end of the settlement, he will give the 102 rupees and take back his bonds. That 102 rupees, that tri-party agent will give it back to the person who has lent 100 rupees. That's all. Now coming as treasury bills. See, treasury bill is a short-term borrowing by the government of India. Treasury bills have a maturity from 91 days, 182 and 364 days. See, if you go to the RBI, site, you will see that RBI carry out weekly auction of treasury bills. If you subscribe to the RBI, website, they will send, every week you will get mail. What are the different types of auction which are happening? 90 days option, 182 days option, 364 days option. You say it, yes, it is not available for public only due to the fact that you have to first register yourself in the RBI website, and you should become a member of that. Then only you will be able to trade on buying these treasury bills through auction. So these are zero coupon securities, all these treasury bills which are generally issued at a discount. Now let us come to the cash management bills. See, cash management bills are also issued by Government of India, and it is very short-term bills. See, it is usually issued to fund temporary mismatches in the cash flow. It has maturity less than 91 days. It has a face value of 10,000 and multiple thereof. Commercial paper applicable basically to corporates. So it is the short-term unsecured borrowing by the corporate. So if you buy any commercial paper, corporates are not going to give you any security. It is an unsecured. If the corporates tomorrow go bankrupt, you will not get your money back. That's why it is called as unsecured borrowing. Corporates will not give you any security or guarantee that they will return. They say we will give you some interest rate. The interest rate will be generally higher than the government bonds interest rate. If government bond is giving 5% interest rate, your commercial paper may be giving 8% or 10%, or some of the corporates even give 12 to 15% interest rate. Like Shriram Transport, Bajaj Finserv. If you put your FD out there, they will give you 7, 8, 9% also, whereas your SBI rate is 6.5. Okay. They mature within 1 year and are issued with a duration of from 7 days, 14, 91, 182, and 364 days. See, if you have to invest in commercial papers, you should ensure that the corporate entities have a very good credit rating. It is always issued in the multiples of 5 lakh. See, commercial papers are issued by the corporates for working capital requirement. What do you mean by working capital? Working capital means day-to-day expenses happening, purchase of some item, paying of wages. These are all called as working capital. So these commercial papers are issued by the corporates for working capital requirement. Now coming to certificate of deposit. CDs are issued by banks and financial institutions. It has a tenure of 1 to 7 days, issued by a face value of rupees 1 lakh and multiples. Financial institutions generally issue certificates of deposit of tenure greater than 1 year but less than 3 years. Okay, and usually CDs have a maturity of 91 days. Now, corporate bonds repo. Just the way we have got a government, repo, okay, market repo, which we discussed. Just like that, you have got something called as corporate bond repo. It was introduced by the RBI in 2010. It can be traded as an OTC, means over the counter, or on stock exchanges. What are the securities which are eligible for this corporate bond repo? Any listed corporate bonds and debentures can be traded on this corporate bond repo market. Commercial papers and certificates of deposits can be traded, and units of debt exchange traded funds can also be traded on this CBO. See, the most active segment of the Indian fixed income security market is your government bonds. Banks and financial institutions invest in government bond market for strategic SLR requirement and long-term stable and secure returns. So, in government bonds, who are the major contributors? Banks and financial institutions. Why do they invest? Just for the SLR requirement and long-term stable and secure return. Okay, government bond usually give you secure return. Reserve Bank of India is one of the largest holder of government bond, which help them to manage the market liquidity. I have already told you, RBI manage market liquidity through buying and selling of government GSECs, government. RBI is the depository of GSEC, that is government securities. GSEC is nothing but government bonds, and also the merchant banker and transfer agent. I will tell you what is primary dealer, what is merchant banker and transfer agent. Okay, banker and primary dealer are the same. Merchant banker is nothing but there are some merchant bankers which are already nominated by RBI. Previously, RBI is the one who used to manage the government bonds GSECs, which are issued by the government of India. Okay, now they have RBI, even though they are the depository, they have given this responsibility after 1995 to certain big entities like Goldman Sachs, RBI guilds, ICICI Securities, and some of the banks have been nominated to perform the function of the depository along with the RBI. They are called as the merchant banker. Their main job is to buy and sell the GSECs in order to help the government to perform their whatever is the expenses which they want to make, fiscal policy they want to make, they can make through this buying and selling of the GSEC. So that is known as primary dealers or merchant banker, and transfer agent. They are all the means the same. Okay. Now let us understand types of bond instruments. First one is the treasury bills. I have already told you. Then cash management bills, dated GSECs. Dated GSECs is nothing but this is the largest component of government sector with maturity from 1 year to 40 years, right? It is issued on the basis of issue calendar issued by the RBI. Fixed rate bonds will have fixed coupon but issued biannually. Floating rate bonds was introduced in 1995. Now coming to the zero coupon bonds. See, there are, other than GSECs and all, you have got something called a zero coupon bond. Then there is something called as capital index bond, which was introduced in 1997, where the principal amount, that is 100 rupees if it is there, that will be always indexed to the inflation. As the inflation rises, the principal amount will also rise. As the inflation decreases, the principal amount, the value of the principal amount will decrease. Inflation index bond have their principal index to world price index. we have already discussed in detail bonds with call and put option. Now, special securities are nothing but certain types of bonds which are issued as a compensation by the central government in lieu of cash subsidies which they are supposed to give to certain entity like Food Corporation of India, Indian Oil Corporation, fertilizer companies, etc. You know what? See, fertilizer company, they manufacture fertilizer, but the cost of the fertilizers, which at the rate at which they are selling, is far less than the rate at which it is manufactured. So in order to ensure that the fertilizer company does not lose out, government support these fertilizer companies because fertilizer is required by the farmers. Similarly, for Food Corporation of India holds lots of grains and others. They are the largest holders of the granary. So, in order and the grains and all which they are going to sell at fair price shop is far less than the market price. So, how are they compensated? The government has to pay them cash, in lieu of the less price which they are selling in the open markets. This applies to Indian Oil Corporation also. So all these cash subsidies, sometimes the government may not be able to pay these cash subsidies. In that case, they are going to issue special bonds. These special bonds are called as special security. However, these special security issued are not eligible for SLR, and hence they have higher yields. Now, there is another platform called as separate trading of registered interest and principal of securities. Don't get confused by this long definition. It is they are going to trade the principal amount of the coupon of the bond and the interest part of the bond separately in a open market. That is known as stripes. Okay. See, suppose if you have a 230 dated bond with coupon rate of 5%, then the principal amount becomes principal strip. That is, the principal amount will be traded separately in the market. Then the coupon cash flow becomes a coupon strip. That is, the coupon cash flow which you are going to receive will be traded separately in the market. Other than this, there will be sovereign gold bonds, which each one of us knows. Nowadays, sovereign gold bonds have been sold in even the broker platform like Zerodha, 5paisa, everywhere. And now a new sovereign gold bond is presently open. See, sovereign gold bond is usually linked to commodity prices of the gold. The denomination of the sovereign gold bond is 1 gram and multiples thereof, and they pay a fixed coupon per annum biannually. As of now, I think it is 2.35% if I am not wrong. So annual payment of 2.35%, but it is paid biannually, twice a year. The redeemed value of the 1 gram of gold. Suppose if you have invested in 1 gram of sovereign gold bond, the redeemed at the time of redemption, the price will be calculated based on the last 3 prices published by the Indian Bullion, and they take the average of that, and that price you are going to get. There are something called as taxable bonds. See, taxable bonds issued at par of 1000 and multiples with there will be no maximum investment limit. Whatever interest you receive are taxable. This is basically for retail investors like us. State development loans, I have already told. These are the bonds issued by the state government. They also do semi-annual paying. But the state development banks, any bonds issued by the state development banks, if it is, the lending is done by the banks, it is eligible for the SLR and borrowing under liquidity adjustment facility of the RBI. I will explain SLR and liquidity adjustment facility in the subsequent slides. Uday bonds issued for state discoms financial support are not eligible for the SLR. Now let us understand what is repurchase agreement, which we use so often in the previous slides. See, repo is basically a money market instrument used by banks to borrow money from the RBI. So repo means who borrows the money? Banks borrow the money from whom? RBI. It is a collateralized lending. It means the bank has to give something as a collateral for lending by the RBI, wherein any government securities, oblique bonds are specified by the RBI can be used. So banks, they generate income by investing in some bonds. So they may be holding some bonds, government bonds, or they may be holding some state development SDL bonds. So all these bonds and the government securities which the bank is holding, they can give as a collateral while taking money from the RBI. So repurchase agreement has got two legs. Leg one is RBI gives money to the banks based on the collateral. So RBI gives 1 crore, let us say, and they say, okay, you give us bonds equal to 1 crore, which you have bought from the open market, and we will keep it with you. So as soon as you return that 1 crore, we will give you back that 1 crore back. That is what. In leg 2, the RBI receives principal plus some interest as agreed upon and returns the bonds back to the banks. So this is known as repo, repurchase agreement. The period of buying and lending is called as the repo period. See, when the repo rate is greater than the current yield we know, we have already discussed, then the repurchase price will be adjusted higher, indicating that there is a capital loss. I hope you understand this. See, when the repo rate, the repurchase rate is higher than the current yield, you have to adjust higher so that there is going to be a capital loss for the RBI. Similarly, when the repo rate is less than the current yield, then the repurchase price is adjusted lower, indicating a capital gain for the RBI. Repo results in induction of liquidity in the market. How? See, you are giving money to the bank, means bank is getting more money for them for the 14 days or whatever is the repo period. So that is means money is given by RBI to the banks, hence liquidity is increasing in the market. The reverse repo is nothing but the RBI buys bond from the banks, issued by the banks, or RBI sells security to banks. If they are selling, it means they are taking money from the banks. So reverse repo is usually done to suck liquidity out of the market. Now there is a very important concept if we have to understand SLR and all. There is this important concept of net demand and time liability should be understood, because everything will be calculated as a percentage of this statutory liquidity ratio, CRR and LAF. They are all adjusted as a percentage of net demand and time liability. The net demand and time liability looks very complex, but it is very simple. See, net demand and time liability have 1, 2, 3 concepts. One is demand liability, another is time liabilities, and another is other demand and time liability, minus all assets held by bank. Now, what are demand liabilities means? Any provident fund or anything which has matured, which is supposed to be returned back to the investors, is called as demand liabilities. So demand liabilities are those liabilities like matured FDs, savings account holding. Even savings account holding you cannot touch. They are all demand liabilities because the person can come and take the money any day he wants. So that will come under demand liabilities. Whereas time liabilities are unmatured FDs which are there with the bank. So these unmatured FDs are time liabilities. You have to pay back. You have to give back those money after a period of time. Assets are nothing but all the monetary assets held by the bank at any particular point of time. Now, what is cash reserve ratio? That is why, see, it is a percentage of NDTL a bank has to park with RBI as per the RBI norm. So, cash reserve ratio is basically done to ensure that some amount of money always remains with the bank, irrespective of any problem with the bank is facing. See, bank suppose gets 1 crore deposit from the retailers. Out of that 1 crore deposit, after calculating this net demand and time liability, whatever the NDTL amount which is left with the bank, a percentage of that has to be parked with the RBI. But because the bank cannot touch it because the money will be with the RBI. So it is usually 4% of the NDTL. So that is called as cash reserve ratio. Cash reserve ratio is some amount a bank has to keep with the RBI. How much is that amount? That amount is 4% of the net demand and time liability. It is a liquidity management tool of the RBI in the economy. See, if the RBI increases the cash reserve ratio, it is taking the money out from the bank because they are compelling the bank to put more money with the RBI. So tomorrow let us assume that the CRR becomes 8%. So the bank has to keep more money with the RBI. So the money will be sucked out of the system from the market. Okay. Now, a very important part is RBI does not pay any interest on the cash reserve ratio. Any amount deposited by the bank with the RBI as a CRR, get no interest. Now coming to statutory liquidity ratio. Statutory liquidity ratio is again the percentage of net demand and time liability. The banks and foreign institution, financial institution has to keep with themselves. They don't have to keep with the bank, but they have to keep with themselves. They can keep it in the form of G-Secs, government bonds, and in form of cash or anything else, but it should never be used for lending. It can be in terms of gold, it can be in terms of cash, or it can be government securities. But government security should not be traded, gold should not be traded, and cash should not be lent to anybody else. So that is the amount of SLR which is required. SLR means a percentage of NDTL the bank has to keep in the form of gold, cash, or government securities called as statutory liquidity ratio. Again, it is a whereas CRR has to be kept with RBI, SLR is to be kept in the banks itself. This is again another form of liquidity management tool by the RBI. See, it is presently 18% of the NDTL. So 18% of the net demand and time liabilities held with the bank should be kept in the form of either gold or cash or government securities and should not be used for lending purpose. Actually, this particular SLR is considered as a captive market. Captive matlab local market for government checks with no refinancing risk. They don't have to refinance it because usually bank has to keep SLR. So most of the banks instead of keep it in gold and cash, they will keep in government securities because government securities generate some amount of money. So that will be a captive market for the government. So when the government need no more money, they can just increase the SLR. Now coming to liquidity adjustment facility. LAF means liquidity adjustment facility. See, it is a money management tool for the banks where banks can borrow and park excess funds with RBI for a day-to-day liquidity management. So it is a facility given by the Reserve Bank of India to the banks. If they have got excess money, they can park with the RBI, or if they want liquidity, if they want more money, they can borrow from the bank. It is an overnight lending and buying facility, not for long periods. Lending and borrowing is done through repo and reverse repo. It means if the RBI is lending money, then the bank has to pay repo, whatever is the existing repo rate. And if the bank put some money with the RBI for a day or two or an overnight, then reverse repo is the rate at which RBI will pay interest for the amount deposited with the bank. You understood, no? Liquidity adjustment facility means suppose I am a bank. I have got 1 lakh rupees. I want to keep 1 lakh rupees for 1 day with the RBI. So I will say, suppose the repo rate is the rate at which RBI lends money to the banks, isn't it? And reverse repo is the rate at which RBI gives interest to the banks for the money they take. Suppose if I put 1 lakh rupee with the bank for one night, I will get an interest equal to the reverse repo rate. If I take 1 lakh rupee from the bank for one night, I have to pay interest rate which is equal to the repo interest rate. So rates for lending and borrowing is set during monetary policy announcement. See, monetary policy is done every quarter. So during that period, these rates of lending and borrowing is done. Again, LAF is set as a percentage of net time and net demand and time liability. So if the banks require more liquidity, they can use MSF and MSS, that is market stabilization scheme. So what is MSF? Marginal standing facility. Suppose if the bank in dire need of liquidity, for example 1 to 2 days, then they can pledge whatever GSEC held in statutory SLR with RBI at rate higher than the repo rate. Usually the rate demanded by the RBI will be slightly higher than the repo rate. So marginal standing facility permits the banks to use the government securities held in their SLR to deposit as collateral with RBI to take money for overnight or for 1 or 2 days. But they have to pay an interest. What is the interest rate? The interest rate will be slightly higher than the repo rate. MSS means selling of bond by RBI to suck liquidity from the market. So these are the various aspects. Now in the next video, I will cover small saving instruments available to retail investors. Thank you very much.